The following podcast was recorded on November 14th, 2024, as a live webinar. This is an edited version of that conversation.
Hi, welcome to Expert Conversations Beyond, where our experts break down some important trends and themes that we see with clients in capital markets. I'm Amol Dhargalkar. I'm a managing partner and chairman of Chatham's board, and I've had this discussion today with Mark Weiss and Reuben Daniels. Mark is also a board member and head of real estate at Chatham, and Reuben is a managing director and head of our global capital advisory team. I hope you enjoy the conversation. We're going to cover three big themes today. And the first is the availability of capital. The second is the cost of capital. And finally, a theme that we've been hearing about for quite a while now, which is how technology can really enable better capital markets decisions and some of the examples that we're seeing in amongst our clients and in the market about that. Before getting into it, you all had a chance to get a little bit of a bio on both Mark and Reuben. I'm just going to brag about them because they're so shy. Otherwise, Mark has spent a career in commercial real estate. You led the lending desk at Goldman, went to be president of a mortgage REIT, then worked with a large investor before coming to Chatham. Reuben, starting in derivatives, working in debt capital markets, broad investment banking, leading investment banking at Barclays, and starting your own firm, EA Markets, coming to Chatham a year ago. Really excited for me to be able to send you all of the hard questions today, and I'll take all the easy ones. So before we get into the agenda, though, I actually want to take a step back and talk about the last week of what's been a pretty significant set of events. We had the election in the U.S. We, of course, had a Fed meeting and a press conference from Powell. So why don't we start with you, Mark, and just share, what takeaways do you have from the last week? Did it change how you think about anything, especially going forward? Share a little bit of your thoughts.
I think it's a really interesting question, Amal, and I think there's no right answer to it. I think when everybody's looking at the policies of the new administration, whether it be on deregulation, whether it be on immigration, whether it be on tariffs, you have all these things that are factoring in, and they all could go different ways. You have the government spending from the existing administration, who's going to try to get out as much money as they can in the next 60 days, which could push up GDP in the beginning of next year. And if you have immigration, you have less workers. So does that hurt GDP? There's all countervailing influences going on. And the reality is you have to ask the questions, but you don't necessarily know the answers right now.
Yeah, that makes it for a tough environment. Reuben, what do you think?
Yeah, I think when we first started talking about this 3 weeks ago, there was a lot more uncertainty than we have today. We had very different views of the path forward, and now, probably for the first election in a very long time, we're off to the races in one particular direction. And I think that the evidence that we see in the market today is indicating a relatively bullish tone, a golden age, perhaps, from a business perspective, at least. We've seen that in the equities market. We're seeing it in the spread market and the debt markets, and an enormous amount of, I think, pent-up objectives, pent-up issuance that is coming. So I think that the initial evidence is good. I do think we face some very big challenges going forward. Mark mentioned a number of them. I think we have certainly inflation exposure, but I think the unfunded liabilities at the federal level are a real challenge. So the incoming administration and the business environment doesn't have a clear path ahead. So while we have a lot more certainty than we did 3 weeks ago, I'm not sure that we have 4 years of smooth sailing ahead of us.
And if you look past the last 9 days and just go back 60 days, you had the futures saying that in 25, the rate was going to drop to about 2.8%. It is now 60 days later, and that rate is now 375 as the low, which means 100 basis points less in cuts. And that's, having a significant impact on how people think about the capital markets.
Well, actually, back to that, one of the themes that we've seen is that there's been this pent up expectation of rate cuts, rate cuts, rate cuts. And even when we did a webinar, I guess it was about 2 months ago, we asked the question to the audience and we said, hey, what do you think is going to happen to the 10-year Treasury? And over 80% thought rates were going to go down by 25 or 50 basis points. So before we get into all the other areas, we've seen the alternative, come out. Right, rates are up about 75 basis points, and the 10-year Treasuries are up about 75 basis points. Um, Make the case for why rates aren't going down anytime soon. Not saying this is your view, but make the case for why they're not going down. We'll start with you, Ruben. You're
Sure,
always
sure,
willing to be a
sure.
little contrarian.
Well, look, I think that the key message, as people have said, is don't believe the experts. I think that's the first message. I think the reality is that when I think about the rate environment, I think about a long-term shape of the yield curve. And we've been living through a very uncomfortable yield curve that isn't set up for business climate, which is an inverted yield curve. And it's been very unusual to have an inverted yield curve of that shape for that long. And my estimation is that we're going to see a return to a more traditional yield curve where the term structure of interest rates indicates that longer term rates should be higher than than short term rates. It seems as though short term rates are coming down, and the reaction to that has been a steepening of the curve on the long end. And I think it's really important because when people talk about cost of capital, they talk about which part of the curve do you mean? Do you mean short-term bank cost capital, or do you mean long-term fixed rate capital, or even the cost of equity? So I think the yield curve is going to be more indicative of a traditional yield curve shape in this new environment, which indicates to me a continued decline in short-term rates and a continued increase in long-term rates.
And to add to that, if you look at what's gone on in the labor and inflation market, yes, we had a difficult print a month ago, but there are factors, exogenous factors like the hurricanes, but the job market has been relatively stable. And then you've seen a print yesterday on core CPI of zero point 0.3, which has been for the last 3 months of zero point 0.3. So it's annualized 3.6%. And so inflation is naggingly staying high and not getting towards that 2%, which I think is part of the reason you're seeing the forward curve move up 95 basis points. And if you look at the long-term risk premium or term premium to the Treasury market for the 10-year, it's about 150 basis points. So if the new forward curve is correct at 3.75% as where you get down to at the end of 25, add that 150 and you're talking about a 10-year Treasury up 80 basis points, not down to about 5.25. So there's a case to be made. You certainly can make a case in either direction, but there's certainly a case to be made that long-term rates are going to stay higher for longer.
I agree with that. And I think that another way to triangulate to that outcome is to look at the level of real rates. And if you just take inflation and some form of risk-free nominal cost of capital, I think 5 to 6% doesn't feel uncomfortable from a 10-year perspective.
You guys are just full of good news to kick this off.
Mhm.
Let's actually talk about availability of capital. We've had a few questions come in on this. Ruben, let's start with you. And there have been some pretty dramatic changes in
Sure.
sources of capital over the last few years. Talk a little bit about how you think about the world right now, and in terms of where capital is coming from, how available it is generally.
I think the word I would use, not only on availability of capital, but on many things we see today, is acceleration. The trend around availability of capital has actually been relatively consistent directionally, but the speed at which it's changing, I think, is increasing, not decreasing. And in particular, private capital is something that we hear a lot about in the press. It's been going on for 25 years, went from zero to $2 trillion of availability in private capital, particularly private credit. And that, I think, is going to continue to accelerate. I think large asset managers have realized that there is an immense market structural shift to be had in moving and disintermediating banks, going direct to companies for capital. And that can be senior, it can be mezz, it can be structured joint venture capital through uh, the lens of large asset managers, I think, is a trend that's going to accelerate this longer term trend of private capital development.
That's interesting. And I think in real estate, Mark, the private debt funds have been around maybe a little bit longer than this, but what are some of the trends that you've seen on the real estate side in terms of availability of capital?
Yeah, and it's definitely the tale of two cities, or the tale of, to quote Charles Dickens, or the tale of two assets. So if you're in the multifamily space, you have Fannie and Freddie Mac, who are just aching to put out money and have put out an enormous amount of money in the last 6 months. The CMBS market, but for multifamily and for other asset classes, is screamingly wide open. Insurance companies are, dipping their toes back in and have some availability. Where I think you're seeing the biggest hiccup is on, small and regional banks. They've had a hard time getting their loans repaid. A lot of them tend to be smaller and office assets, and they're just trying to work with their customers who keep deposits at the bank to try to, extend, figure out ways to help their best clients. But because they're not getting any repayments, they're not having any availability. So the market, which is a typical for a small customer, is having a harder time, which is why you're seeing things like the CMBS market, more open up. And as you mentioned, Amal, private credit has been around, for 20 years on the real estate side, whether it be debt funds or public mortgage REITs. And those guys, while they have been a little bit more limited on the public side, on the private side, they're just, getting lots of money and aching to put it out.
And it's interesting because as we talk about different types of assets, one of the questions I think a lot of our audience has, especially for those that aren't as much in real estate, is you hear the doom and gloom. If you open up the Wall Street Journal, or not even have to open it up these days, just front page of it. What are the asset classes that are doing that you find that there's just a lot of capital available, and where do you find that it is much more challenging?
Well, when you look at where a lot of people are investing today, you'll see multifamily, industrial, and to a smaller extent, things like data centers. And the market is wide open for those. And because the fundamentals are still pretty good. Office is, by definition, a challenging market, and everybody reads about it. But, give you an example. If you had an asset that was $100 million and you thought you were being conservative and you only borrowed $60 million and you did everything right, your property is 95% leased, it's going great. Today, that asset might be worth $70 million, just because of the nature of where people are putting capitalization rates on office. And if you could borrow 60%, because it's still challenging to borrow high leverage, 60% of 70 million is $42 million. So you thought you were being conservative when you borrowed 60. Now, to right size the loan, you have to write a check for $18 million. And I think that's the big challenge in the office market. The SASB market, the single asset securitization borrower market in the CMBS, is probably where a lot of the bigger deals are getting done on the office side. So that's open, but selective. But other than that, if you are a Class B office asset, and there are definitely winners and losers in that market, you're really struggling.
And Ruben, I know you work with a lot of REITs. They kind of straddle this world of corporate finance, real estate finance. How are they making sense of the world? What are some of the trends you're seeing there?
REITs are a great, fascinating space. I'd say that they were the canary in the market's coal mine because they bring together a lot of different financing aspects in a single entity. So that can be both corporate level financing and asset level financing, like Mark was describing. It can be unsecured, it can be secured, it can be investment grade, it can be high yield. So I think there is a lot to be taken away from the real estate space, from the REIT space in particular. And I think that availability is clearly stronger there overall. The data center space, digital infrastructure, enormous deals, enormous amounts of capital flowing into that space. The sources are changing, as Mark pointed out, whether it's the debt funds or it's the banks. There are definitely banks that are more likely to invest in certain segments of the REIT space versus others. There's a lot of regulatory pressure around that. And I do think, to go back to the last question, we're seeing a lot more utilitization of the banks, where they're really conduits into the deeper financing markets, like the SASB space or like the direct lending space. I think the cost side is interesting for REITs. When in 2020 and 2021, they were refinancing at relatively low rates, 3 to 4% on the investment grade side, and now they're looking at 5 to 6% rates. And when you take Mark's example of that office property and the gap that's created by the shifts in sources and leverageability of those assets, those need to be refinanced, and their rates are much higher. And when that influences your your coverage ratios. It influences your leverage ratios. It opens up this opportunity, which I think is very large today for REITs, around structured capital, mezz capital, gap financing, finding ways to bridge that hole in the balance sheets that Mark was describing.
And one of the things that, the REITs have the advantage is typically you will not see REITs go over 40% leverage as an entity. And because of that, even if they have secured debt that may have to be resized, they do have capacity, within the balance sheet to typically handle those problems.
It's interesting because it sounds like a little bit of a different playbook to today than before. How do you navigate, as you're working with clients, finding and figuring out which lenders are best,
Right.
given the situation?
Well, it's a great question, and it's interesting because while there is a superabundance of capital today, in some ways, the world is much more fragmented. The days of having on the one end a bank facility and the other end having public market IPOs are long gone. There are so many different flavors of capital and so many different pockets of capital that it's much harder, I think, particularly for corporates, to navigate that space. The industry isn't designed to go out and do and find those pockets of capital. The industry is designed, and when I say the industry, I mean the capital markets industry is designed around the banks to really do broadly syndicated deals where you bring a transaction like a bond offering and sell bits and pieces to a broad set of investors. But I think the market's moving towards a much more concentrated environment where large asset managers have their own origination function where they're going out and finding deals to lend to, not in 10, 20, $30 million slugs, but in 3, 4, $500 billion slugs. And I think that's a trend that's going to continue, but it's very hard for the issuers to find and access those names.
And the other thing you're seeing on the secured side, Amal, is unless an asset is right down the middle of the fairway, typically if 5 years ago, you'd go out to 10 lenders, you'd get 7 term sheets, you negotiate that down to the 2 best, and you pick a winner. Today, you're not going out to 10, you're going out to 40 because you don't know who's in the market at any particular moment in time today. And you're going out to 40 to hopefully get 2 or 3. And so you have to take a much more broad approach as to the lenders you're going after to try to get that 1 or 2 really nice quotes for your asset.
We just worked on a deal recently in the REIT space, a challenged subsector where we had that exact scenario. And what's interesting is when you do an analysis of comparables, who are the lenders to the space, and you go to them thinking those are the most likely names to continue, turns out they're the least likely because those are the names that are overexposed and have had regulatory pressure to reduce in the sector. And so the names that we actually did find were the ones that 3 or 4 years ago would have been at the bottom of our list, but they don't have enough exposure. So there are lots of different ways to navigate the fragmentation of the market, and it's not always what you expect it to be.
Oh, that's interesting. We have a few questions here from the audience. So I'm going to hit these before we go dive deeper into cost of capital. One is actually, Mark, I think this would be good for you. Can you touch on availability of capital for retail assets in real estate?
Yeah, and I think retail is an interesting. If you take a look at malls, and again, I don't necessarily think we're talking about malls, but 7, 8 years ago, malls were actually a dirty word. And through the lack of financing and availability, you really culled the market in terms of going from class A, B, and C malls to really only having A's and B's left. And so the cost of capital and the availability of capital actually had an impact on the market. I think today on the retail side, you're still seeing assets like strip centers that, have a function, grocery anchored centers that, draw people. You still can have the availability of capitals there. The leverage is definitely not as high as it once was, and we'll talk about cost of capital in a minute. But retail is still available. I think where you're struggling is when you have single tenant retail with shorter term leases. That's when it becomes a problem because lenders could be staring into the face of an empty building, and that's where lenders are kind of drawing the line.
Yeah, but I would just add that I'm a big fan of Amal's.
Oh, that was that we had 20 minutes in as the over under before there was a
Unplanned.
dad joke.
Completely unplanned.
Well, now I'm going to give you a tough question.
Please.
We have a question from somebody in the leasing industry.
Yes.
Securitizations. There's a lot of regulatory change happened. What are your thoughts on what securitization markets will look like,
Sure.
particularly for leasing firms?
Sure. Securitization is a fascinating area and certainly growing. And there are some very strange pricing dynamics in the secured space today. And we can talk about why that is. I would probably blame QE for it. But the pricing, I think, in many markets, secured and unsecured is, I think, more attractive today from a cost basis, which isn't supposed to be. Secured is supposed to be better. But what's interesting about secured is it allows lenders and capital providers to be far more aggressive about availability. And so, by securing assets and priming other assets and raising the quality of credit protection, allows people to help to fill the gap that Mark was describing that's created as leverage has declined, leverage capacity has declined. So I think secured is actually a very important tool for getting access. It's not as cheap as it was, and I think that that's something that is sometimes hard to grapple with. We have a number of clients who've historically issued in both, and are literally seeing no price benefit to issuing in secured versus unsecured. So again, I think it's availability versus cost decision.
Yeah, counterintuitive.
Very much so.
But
It's an inverted secured unsecured curve.
how many terms are we going to coin here? So let's one more before we get to cost of capital, and this is somewhat related, but we have a question. Really, it seems that the spread between cap rates and 10-year treasuries are historically narrow and compressing, suggesting cost of acquiring real estate is on the expensive end. Yet there's unprecedented amounts of dry powder out there. How do you square those two? What does that mean for acquisitions over the next few years?
I think you're right about the pent-up demand. Interestingly, we were talking to one of our large money manager clients recently who said for the first time in about a year and a half, the pension funds have said they're actually underallocated to real estate now because their stock portfolio has gone up. The denominator effect has left them underallocated to real estate. And listen, real estate for 95% of the world is a leverage play. And the problem is, a lot of people do not want to sell at these cap rates. And so there's a lot of money chasing very, very few assets. And something at some point has to unlock that. People are going to get to their end of their funds. They're going to need to divest. And so the problem is when you have interest rates at, let's just say 4.5 for a 10-year, add a spread of 150 to 200 basis points, that's 6 to 6.5%, which means unless you buy a cap rate higher than 6 to 6.5%, you have negative leverage. Now, you will see that, for example, in the industrial space where rents have run up so much that you can see if you have 2 years left on your lease, you can have a 40% bump in rents. So you can afford to have negative leverage, but there aren't a lot of assets that you're going to do that. You can't do that on multifamily unless you really believe rents are going through the roof, which we had in the last couple of years. So at some point, the dam has to break, but it's not clear what's going to force that to happen.
Okay, these questions keep coming in, and one of the biggest winners in equity markets post-election last week was Fannie and Freddie, with expectations of what will happen to their capital structure going forward. More broadly, though, what is the implication if there's a privatization of Fannie and Freddie from a capital availability standpoint and on the market? This may be as much about personal mortgage rates as it is about anything else. But either of you want to take a stab at it?
Feel free, my friend.
Look, I think that in general, I'm predisposed to privatization versus not privatization. So I suspect that will be a long-term positive. I think it's hard to disassemble the resi market from that infrastructure. So I'm not sure that there is a clear path to both privatization and what that impact is going to be. I have noticed that long-term mortgage spreads to the Treasury for borrowing for residential are much higher than they've been in a long time. They're upwards of 250 to 270 over the long bond. And we're working on some corporate deals that are investment grade, but issuing at literally 40% of that spread. We just saw 2 deals get done this week in the healthcare space in 30 years that were sub 100. So you look at someone's home mortgage as being a spread of 250 to 300 over the long end, and that is secured by the property and by the person who actually lives there versus an unsecured corporate bond that trades significantly tighter. Again, it goes back to this point that I think there's some fundamental structural challenges. I'm not sure that it's just a Freddie Fannie issue, but I think that it's very difficult, despite our best hopes, to privatize and deregulate all these markets instantaneously. I'm skeptical that even the famous people in charge of doing that are able to do so in short order.
All right. One more here. How do we stop the private credit boom from becoming the next global financial
Mm.
crisis? If you have the answer to that, you might.
Well, I think the answer is we don't.
All
I
right.
think the
Say
answer
more.
is we don't. Well, I think the challenge in private credit is that it is not as regulated as the banks, and that is I think in some ways a very good thing. But I think when there is a problem in the private credit market, and there will be a problem in the private credit market, not clear that we're going to have, certainly with this administration as well, the wherewithal to bail that out. So I'm not sure that there is a natural path to avoid what that.
Yeah, when you look at the regulated banks and the stress tests, there are limiting factors being put on, that these are strategically important institutions. You don't have that on the private credit side. And to Ruben's point, it's virtually completely unregulated, and the problem will happen. It's just a question of when, and you just hope it doesn't get too big before that problem occurs.
Yeah, I do think it's interesting that there were some very difficult times in the last 2 years in private credit, and the market was able to withstand it and probably come out stronger on the other side. So, I'm not sure that it is by default going to be a problem, no pun intended, in that sector. I think the bigger concern I have is if there is malfeasance and bad behavior in that market. I actually think there are a lot of mechanisms in place institutionally, a lot of incentive for these firms to get it right around private credit. But my bigger concern is fraud and malfeasance that's not undetected.
Okay. All right. On that cheery note, let's talk a little bit about cost of capital. We both alluded to it and made some hints towards it. Taking a step back, what does cost of capital mean? To you, Reuben.
I
We'll
got to
give
go
you
first?
we'll get you a chalkboard, and
Uh-huh.
you can start
I,
stand up there.
I'm no academic, but I think that for me, when I think about cost of capital, there is cost. When people talk about cost of capital, they're often talking about the cost of bank debt, and I think that's not as broad an approach as I think is required to understand cost of capital. I would fall back on a capital asset pricing model that we learned about in business school, which basically says that the cost of capital is a combination of your debt costs, where you are on the curve, your risk-free rates, and the cost of the equity premium associated with the increased risk of owning equities. And I think generally speaking, the cost of capital from a corporate perspective, big picture, relatively stable. Movements in rates, change the shape of the yield curve don't really have an enormous influence on cost of capital. Certainly a much bigger risk cost of capital wise between a G7 market and a developing market. That's where you're going to see the biggest effective difference in cost of capital. But I think in general, cost of capital, big picture, stays relatively stable. I think what's more interesting is around the where you get that cost of capital, and it goes back into this structural question. Are you getting it from the bank market? Are you getting it from the bond market? Are you getting it from private credit? And where in your capital stack does that capital come? Mezz, pref, and so on. And I think that what we're going to see is a shift between those as the relative costs of capital change. And clearly, it's going to be a lot more advantageous to be in the short end when rates are falling, and less advantageous to be issuing when rates are rising in the long end. So I think we're going to see the market follow where those underlying rates go to attempt to reduce or minimize the cost of capital. But at the end of the day, corporate cost of capital stays relatively stable.
I'm going to try and follow Professor Daniels for a second here. Real estate is a much simpler analysis. There's, typically secured debt. We're not talking about the REITs for a second, secured debt and cost of equity. And And this is what we talked about in capitalization rates earlier, which is why the capitalization rates have gone up. And I'll give you just a simple multifamily example, which if you thought about it, 4 years ago when you were trying to build a project, you'd borrowing floating rate over LIBOR, now SOFR. It was about zero. You had a couple hundred basis points for the spread, and you were borrowing at 3 to 5%, let's just say. Today, obviously, SOFR's up, it was up over 5, now it's sort of 4.5, and spreads are, typically similar. So you're borrowing at 7 to 9%. So that, number one, the cost of your debt has gone up dramatically. Number two, you were borrowing probably 70 to 75%, and today it might be 55 to 60%, maybe 65%. So that means you have more equity to have to put in. Okay, now let's talk about equity. 4 years ago, you could build a multifamily project. You offer an investor 12% return, levered return. They were all over it. Today, 6 months ago, that might have been 20%. Today, that might be 18%. Layer on to all of that, things like construction costs, insurance costs, all those things have gone up. And so there's a reason why very few multifamily projects are coming out of the ground right now, because the math just doesn't work. And so cost of capital is a real problem, but it's not just debt, it's also the equity.
Yeah, that's interesting. And then maybe we didn't you skipped over the REITs part, but back to you, Ruben. One of the interesting booms that we saw probably over the last, call it, 12 or so months as rates were going up was not just REITs, but companies of all types using the convert market. Convertible debt was and maybe still is relatively popular. One, why do you think that is? And
Sure.
two, as you look forward, what do you think it means
hmm
for 25 and beyond?
Well, I think converts are naturally a very popular place for borrowers to look, primarily because the nominal rate that's quoted on the convert is often significantly lower than what they could otherwise get. And I think that there's an entire ecosystem in the marketplace built around convert issuance, from legal to underwriters to investors who are very bullish on and very positive on the convert. And I think there are definitely scenarios under which a convert can be meaningful for a company. I typically don't believe that absolute or nominal rate that's quoted is that reason. Uh, the challenge with converts from a corporate perspective is what I call adverse execution. And what that means is that it always looks good going in, and in almost every scenario coming out, it does not look quite as good. If you want it to turn into equity, it doesn't, and when you don't want it to turn into debt, it doesn't. And so the hindsight is always more challenging on a convert than what it looks like going in. That said, there are clearly times when a convert makes sense. Uh, and you're going to ask me what that is, and I'll answer. What makes it make sense to issue a convert is when you have an equity type risk that you're financing. So if you have an acquisition or you have a business or a organic growth opportunity that has equity like returns, I think an equity type financing makes sense. But I think that they do tend to be overused for purposes of reducing the nominal interest rate. And I think that's something that I would definitely think twice about.
You think it'll stay as popular if we get into a cycle where, to your point, if the curve starts to reinvert, will they remain as popular, or you think they'll kind of fade into the
I
background
think
a little
so.
bit?
I think corporates take a very simple view of the convert space, and we were working with some REITs that were looking at converts, and when the cost differential between unsecured and the uh, as Mark was saying, the historical rate and their unsecured cost was 3 or 4 percentage points. The math didn't work, as Mark was describing, and the convert looked more interesting. But we've seen REIT costs of funds come down 100 basis points. And so when they came down 100 basis points over the summer, all of a sudden, maybe it's not worth selling that equity upside through the convert, and I'm just going to issue an unsecured bond. And I think there is some number between where rates were 4 or 5 years ago and where rates are, where REIT issuers in particular are going to say, yeah, it's tight enough that I'll just refinance unsecured, or it's so wide that I really need to juice my nominal cost lower through a convert by selling some equity.
Interesting. And on that point, we actually, as we focus more rather than cost of capital, more on cost of debt, we have seen, you know, historically tight spreads in both investment grade. Not and this is not specific to REITs or real estate. This is investment grade, high yield. I mean, these are spreads we haven't seen in a
Spreads are
long
tight.
time. What's your outlook for, given where we are, where do you think we're headed and why?
It's a great question, and I think it's hard to imagine corporate spreads coming tighter. I have heard, in fact, in a call earlier this morning, there are talks of corporate spreads continuing to tighten, and I think the challenge with that is there is a government ceiling to cost of funds for corporates, and in emerging markets, you do see corporates trading inside the government cost of funds in those markets. I That's hard to imagine here. I think on a spread basis, it's hard to see spreads come much tighter because you do approach zero at some point, and I'm not a big fan of negative cost of funds for corporates here in the U.S. But I think uh, my suspicion is that rates overall for corporates are going to be driven by the underlying Treasury levels, and I think if we see 75, 100 basis point widening in the 10-year. My suspicion is that that will continue to be, we'll still continue to see low spreads, but rates are going to be 50 to 100 wider.
Yeah, and you're seeing it the same thing on the CMBS side where spreads have come in dramatically. And I think it all gets back to a little bit of what you were saying before, Amal, which was dry powder. There's an awful lot of money chasing these deals, which is pushing the spreads down.
Yeah, and I think in CMBS world, it's probably also a little bit of a different subordination and collateralization that's happening than there was previously. So
100% correct.
there's as a reminder, there's just a lot of levers that can be pulled, and in capital markets, and you can get saying is if you give me the rate, I'll tell you the amount.
Correct. And more levers today than ever before. One of my favorite movie images is of the Wizard of Oz and the curtain being pulled back, because I think a lot of what we do is pulling back the curtain on those levers, and you can see there's 3 or 4 levers and a couple of dials, and I do think that today borrowers have uh, uh, literally double, triple the amount of levers that they had 5 years ago.
Um, well, that's interesting. Now we're going to talk about technology in a minute, but we actually have a number of questions about currencies that we've gotten. So, really strong dollar that we've seen. You could say in the last few weeks, but it's been strengthening over the course of the last few months. I think dollar's up about 6% in just the last 2 months. That's a not quite COVID-like move, but that's a pretty significant move in a relatively short amount of time. So one question is, how do we view currency risk given given the current political environment, increasing potential for trade tariffs, and what types of strategies might we see? But before answering that question, are you seeing clients pay attention to currency risk? I know I certainly am. Mark, I think you've had this conversation as well.
Yeah, I'll just give you a simple numeric example. Imagine 4 years ago, you bought a property in Japan. You bought it for 1,000 yen, and it created 100 yen in terms of income. And at the time, we were pretty much at parity with the yen, 1 to 1. Your business plan was to grow income 5% a year. Lo and behold, you outperformed. You grew at 8% a year. And so instead of generating 100 yen in income 4 years later, you generated 135. And if you sold it for that same 10% return, you would get 1,350 yen instead of the 1,000, a 35% top line return. Amazing. The problem is, since that time, the yen went from 100 to 150. So now you sell that 135, and instead of getting $13.50, you're getting 90 cents. $13.50, you're getting $9. So you've actually lost money on the trade, even though you outperformed your business plan. And the yen was always considered a very stable currency, and so people weren't necessarily paying attention to it. We are getting a lot of calls at Chatham. We have a lot of expertise in this market, in the FX market, about when we buy new products or we have a new fund, how can we be hedging where they may have been unhedged before? I mean, you see another good example is look at the election in Mexico. Prior to the election in Mexico, the currency exchange was about 17. As of this morning, it was about 20 and a half. I mean, that's a dramatic 20% movement. And if you weren't hedged, again, things that you might have thought would be winners could be losers.
Yeah. I would add on the corporate side, I think companies have become very sophisticated or more sophisticated over the past 30 years around managing FX risk. I think on the corporate side, the key step there has been to place liabilities in the places that they have assets as a means to mitigate that currency exposure. And I think that's tried and true. And obviously, Chatham does a lot of work in that area, both in terms of natural funding in those markets as well as derivatives based liability management there. We're also seeing amongst the sponsors, and Mark alluded to this, an enormous interest in share class hedging, thinking through not just the risks associated with it from investing in different markets, but using share class hedging as a means of raising more capital outside, for instance, the US from other markets and mitigating the currency risk associated with that. So an investor in Japan can invest in the US on a yen basis. And I think those types of tools are becoming far more common, not just at the corporate level, but at the sponsor level.
And if I can add on the corporate side, while companies have gotten more sophisticated and there is a much better approach today versus 30 years ago, it's surprising to me that still half of the publicly listed companies in the U.S. that have currency exposure generally are not hedging that currency exposure. Now, maybe it's not that big. It might not be material, but based on the conversations we keep having every day, I think one of the themes that we see is one, if you haven't been hedging it, to Mark's point, probably need to be looking at it because it's not just asset by asset. These are flows that are happening every single
Hmm.
day that ultimately impact your financials. The second is what worked 5 years ago still working today? As you know, talk about Mexico, for example. We've seen over the last 5 years a significant resurgence in nearshoring or friendshoring, as they call it. Those exposures have changed, right? Post COVID, there a lot of companies said, well, maybe I should move some of that manufacturing closer to home because we don't have the same level of consistency and predictability over what happens in certain other locations across the globe. And that's again changed the mix and changed the focus of it. So that's another area that
Hmm.
we've continued to see a lot of investments by I'd say the most forward-looking
For sure.
companies out
I
there.
think for most companies, the default position is I'd rather do less than more. But your point about predictability is really important. And I think companies that look at those international investments and say, uh, I can do nothing, or I can both reduce my risk, create more certainty, and reduce my cost by funding in markets like Europe or like in Japan. That's something I'm supposed to do. If I can reduce risk and reduce cost, that's a beautiful position to be in. And so hopefully they'll make those choices based on what's in their interest to do, as opposed to just saying, rather than just shifting that to my equity holders, shifting that currency risk to my equity holders, that I can mitigate this and reduce my cost at the same time. And I think given what we've been saying about where we see U.S. rates going or potentially going, I think there are lots of markets where non-dollar based financing is extremely attractive.
Yeah, that's right. Okay, well let's actually move to our final theme that we plan to talk about, which is really on the leveraging technology side of things. And I think there's different aspects here. We're going to talk a little bit about what we see in the real estate industry specifically, and then more broadly about what the future of capital markets will be. And you can send all of your AI related questions directly to Reuben here. He's very excited to talk about Skynet for capital markets. But let's actually start in real estate. I know this is an area that we've seen a tremendous amount of interest in from our clients.
Yeah, and Amal, we have, many, many thousands of real estate clients. And so we're having conversations every day with many of these clients. And today we have a product called CDM. And we have, I would call it roughly $2 trillion of debt on this platform. And what it is basically ingesting all your loan documents and putting it into, dashboards that you can feel comfortable and rely on. And what you're seeing today is everybody we are talking to is very interested in real estate technology. And why is that? First is their volume is just lower, so they actually have a little bit more time on their hands to think holistically. And I'd say the second part is everybody who has any amount of real estate has some issue with their debt somewhere along in their portfolio. And they realize might have it on an Excel spreadsheet, maybe. It might be on scraps of paper. They might have to call their lawyer to get an excerpt of their loan agreement, but they don't have it in any one concentrated place. And so people are starting to realize that, they really want to have what we call one source of truth, where they can anybody in that organization can just log on and figure out exactly what's happening, what maturities are coming up, what covenants that might they be tripping. And so these are really, really important factors that people are focusing on. Additionally, we just bought a company, about a month ago called VMX. And it's an asset platform. And basically what it does is it'll take, if you have, let's say, 100 assets across the country, 100 different property managers, all have different charts of accounts. We will take that data, ingest it into our system, normalize that data, and then create outputs that, so you can look at every asset that you have with the same chart of accounts. You can go through rent rolls. In 3 seconds, you can say, what's my technology exposure? So all the technology companies will go. And then they'll say, what's my Amazon specific exposure or any kind of Meta? And you can go through and have that. And what that's allowing is people to spend more time holistically thinking about their asset and how to manage their asset than worrying about ticking and tying numbers. I'm going to read something, which I don't like to do, but we bought this company and a big investor in it was Morgan Stanley. And Morgan Stanley has adopted this technology. And this is a quote from John Klopp, who heads all of real assets at Morgan Stanley. He says, the VMX platform and services are core to our ability to comprehensively analyze our investment portfolio data. He then adds, we believe the acquisition and integration into the Chatham ecosystem will be a game changer for the industry. We really believe that when you have one source of truth and figure out where all your data is and not have to be searching for it and hunting and pecking through spreadsheets and pieces of paper, it's going to change the way you operate your business.
Excellent. Well,
I'm-
thank you, John.
I mean, what's amazing about that is how the remarkable lack of technological development in the institutional processes in capital markets that we see. It's amazing how the real estate market has taken a real leadership position in thinking about how to apply technology. Whereas when we look at the capital markets today and we look at bond syndication, the process is almost identical to what it was 30 years ago. There's a lack of data and information and process flow, allocation of securities. It's embarrassing to see what that market looks like today versus what you're describing in the real estate space. And I do think there's an enormous opportunity there, but people have been talking about that opportunity for a long time. And I believe we are heading into, and you were talking about AI, I think we're heading into a time where finally we may start to see a structural shift in the capital markets from an institutional perspective towards more adoption of technology. What we can do on our phones and our personal accounts is far more than what most companies can do with regards to debt and equity issuance, bank revolvers. That I think is going to change. I think a lot of that technology is going to come from and be ported over from the work that's being done on the real estate side.
It's fascinating to hear because not many folks would come out and say that real estate has been a leader in technology, but I think there has been a lot of investment in prop tech and a lot of interesting solutions have come out.
Sure. We were working on a assignment for one of our REITs where we were able to get a lot of the public unsecured information off of the typical data platforms that exist, but the private data isn't available on those public platforms. So we were able to combine one of the large data platforms that are publicly available and the information there on the unsecured side with all of the information in CDM and to create a much more comprehensive view of this company's rate and liquidity exposures. So I think that I'm hopeful that one of the tech trends that happens is the consolidation of those two sets of skills.
Super interesting. Okay, we have a bunch of questions that are kind of going back to some of the early parts of what we were talking about, and so I'm going to try to hit a few of these before we end our webinar with asking both of you for your words of wisdom
Mm.
to our clients. So let me scroll through here, and so I think first it's probably a broad broad question, but are the policies of the incoming administration inflationary? If not, why not? And before putting both of you on the hook, let's remember that so long as the Fed is focused on fighting inflation, there will always, there's going to be some form of inflation. But if you bet on the Fed, they will work to tamp out that inflation as quickly as possible. So,
Are you predisposing our answer with that? Because I think
no,
one of the challenges with the Fed today is it's a dual mandate. So it's one thing to say if their goal is to manage inflation, that they're going to be able to do so. But with a dual mandate, that's much more
do you
complicated.
think one mandate matters more than another?
I do.
Which one?
Inflation,
Okay.
with almost no question.
Yeah.
And I think going one step further, the challenge that this administration and whichever administration one would be facing is the giant unfunded liabilities that exist in our country. We, as Milton Friedman would say, are in inflation is caused by monetary policy, and we are there. The amount of monetary inflation that we've injected into the system, I think, and fiscal as well, is beyond what we've ever done before in peacetime. And I think we have an enormous inflation challenge, regardless of dual mandate or not. But I do think that, well, and just to answer the question, which was, does this incoming administration drive inflation? I think that inflation is coming and coming harder. I'm not sure that this administration or any administration could actually impact it sufficiently without some very difficult conversations to be had as a country.
And we started the conversation talking about this. And I would say two things. One, I agree with Reuben. You've seen the inflation stall out. And so that could be a problem no matter who is in the administration. But every policy has a positive and negative. If you look, if Trump was able to do mass deportation, which we don't think is realistic, but if he was, you have millions less workers, right? And so they're not spending and they're not paying taxes, right? That's going to hurt GDP and that's going to hurt income coming into the United States government. And then with that, you're going to have U.S. workers take those jobs. And as we said before, wages are going to increase, and that can be inflationary. So you don't know exactly how these things are going to play out. Tariffs, you could say, well, that's great. You're going to build in America. Okay, but now you have to have people get those jobs. And so the products are probably going to be more expensive. So that's potentially inflationary. You might not have enough people to do the job, particularly if you do deportation. So the wages are going to go up there. You're going to have deregulation. That's certainly coming. That's most notably positive for the economy because it's going to boost activity. So all of these things are point counterpoint, and you don't know exactly what's going to weigh out and what exactly the administration is going to focus on.
That's right. I think just making life a little bit more challenging for everyone to navigate going forward. So we have a few minutes left. I'm going to ask each of you for, based on this whole conversation and what you see, and as you look forward into 25, what's one piece of advice that you would give to our clients as we walk away from this? So, Mark, we'll start with you, and I'll take it to you, Reuben.
So I think I'll start with a quote from the famous Green Bay Packers football coach, Vince Lombardi, who said, "Hope is not a strategy." And I think that's very, very important for real estate. I think what's really important is trying to match assets and liabilities. And what do I mean by that? I've seen cycles where people had great buys, but they financed it on 18-month floating rate debt. You see a lot of that has happened in the multifamily market where they borrow floating rate. Rents were going to go through the roof and they were going to refinance or sell and make a fortune. Well, guess what? Rates went up and rents did not. And so these people got caught, and you read about it every day where people are turning back keys to their banks. And so the best one can do is to try to, again, match those assets and liabilities, term out the debt 5 to 10 years. Or if you're going to do floating rate because it's a transitional property, call Chatham and try to buy a longer duration hedge, multi-year hedge, so that you're immune in effect to what's going on with rates, so you can't be punished like the people have been punished with the rates moving up and who have been unhedged in the past couple of years.
All right, follow Vince.
Mm. Uh, so I would say if there was one thing that I think is worth taking away is don't underestimate the role of private credit. I think that has been underestimated for quite a while, and I think it would be a mistake to underestimate that role. If you're a public company, if you're a private company, the private credit train is coming to town. But there's another one that I actually think is worth noting as well. About 25 years ago, Graham Leach got rid of Glass-Steagall. And what that did was really fundamentally change the capital structure, the capital market structure, and it made all the banks become effectively the same, universal banking, where banks were providing M&A and underwriting and lending and commercial banking all in one place. And I think that's a dynamic that's gone on for 25 years. And I think that Chatham was a pioneer in agenting derivatives transactions, working with clients as their advocate in that process. And I think that is something that is going to be coming to the capital markets as well. I think one of the big trends is having advocacy for corporate borrowers in a way that really hasn't existed for a very long time. And so I would combine that with the private credit issue and say those are the two things that I see as the big trends going forward to watch out for.
Thank you for joining us, and I hope you gained some valuable insights to this conversation. See you next time.
Subscribe to future episodes and catch up on past releases on Apple, Spotify, or YouTube. Use the link in the show notes to provide feedback on topics we've covered, other people or perspectives you'd like us to include, or anything else we can do to make your experience more enjoyable.